Okay, so let's proceed to the next problem. You have to be familiar with the term that I will use later on. Okay, so if I say CA, that will be carrying amount. TV will be tax base, and then deferred tax asset will be deferred, of course, DTA. DTL will be deferred tax liability. Temporary difference, we have two types of temporary difference. We have taxable temporary difference and deductible temporary difference. Okay, so taxable temporary difference, and DTD will be deductible temporary difference. Okay. Now, this is what I call cheat codes. Okay, the cheat codes will be like this, and even in CPA review, okay, I'm doing this when I was handling the financial reporting there. Okay, so for asset, if carrying amount is greater than tax base, that will result to taxable temporary difference. Okay, so are we clear? So that will be taxable temporary difference. If the carrying amount is less than tax base, that will actually result to deductible temporary difference. Okay, so if you want to refer to that one, you can watch the recorded lecture, okay, on the explanation, okay, on those temporary and deductible temporary difference, okay, or taxable temporary difference and deductible temporary difference. Now for liability, it will be opposite. Okay, so carrying amount is greater than tax base, that will result to deductible temporary difference. If carrying amount is less than tax base, that will result to taxable temporary difference. Okay, so are we clear? Now, if that will be taxable temporary difference, if you multiply it by tax rate, that will result to deferred tax liability. Okay, now deductible temporary difference multiplied by tax rate, that will result to deferred tax asset. Okay, so clear? Okay. Now, asset, if you're trying to calculate the tax base, this is now really quite complicated. Okay, because you have to remember or recall this formula. Okay, so for asset, tax base can be calculated by having carrying amount plus future deductible amount less future economic benefit. Okay, the opposite will happen with liability. Tax base equals carrying amount less future deductible amount plus future economic benefit. Okay, right. So this one we will try to apply. Okay. Now I'll focus on accrued warranty cost. Okay, so that it's clear for us. Okay. Now, most of the accrued expenses, especially this one, accrued warranty cost, as per taxation's view, it should not exist. Warranty expense should only be recognized when paid. Okay, clear? Now, I hope you're getting that. Okay. So, as per accounting, we are doing accrual. Okay, this one you studied in your accounting units. Okay. So, in accrual, when you say accrued, it doesn't mean that it's paid. Actually, the reason why you're saying it's accrued, you are just recognizing something, right? So when you recognize something, it doesn't mean that it actually been executed. Okay? Or you haven't paid for it, for that particular expense. Now, accrued warranty cost, accounting will recognize only this when they estimated something. Okay? Are we clear on that? That's why we have warranty expense debit and then credit accrued warranty cost. Okay, so this is the journal entry. Now, okay. Are we clear? Okay, so this is the accounting journal entry. As per the eye of IRC, or of course this is Australian, so ATO, Australian Taxation Office, this should not exist. Okay? Are you getting the point? This should not exist. So meaning, as per eye of the taxation office, the tax base should be 0. It should not exist. You got it, huh? Again, I'm not saying what some students will say. So it doesn't exist while you are recording it, right? Now, when you are solving problems for accounting for income tax, you are looking it in two different points. One is per accounting standards, and the other one is taxation rule. So which means this one is for accounting standards, okay, and this one will be for tax rules. So are we clear? Now, even if you are not doing this, you will be able to know what will be tax-based just by using logic. If accrued warranty costs, this entry as per IRC or in Australia the ATO should not exist, tax base should be what? It doesn't exist, so nil, right? Should not be there. Okay? So are we clear on using logic so that you will know if there should be tax base? Okay, so we'll try to do that even if we are not using this. Okay, let's try. Question number 1. Question number 1, it says, a company has a machine that costs $300,000, okay, and has a carrying amount of $200,000. So $200,000, it's there, right? This is our as per accounting. Are we clear? Okay. Now this is the exciting part. Okay. For tax purposes, accumulated depreciation amounts to 180. Sorry, this should be 120. 180. So how much is the carrying amount or the tax base? Carrying amount as per taxation. Why did I put 180 there? That should be how much? 300,000 less 180. Okay. 300,000 less 180. That should be that should be 120, right? Am I correct? 120. Okay, take note. The original price is 300,000. Okay, $300,000. Okay, are we clear? For accounting rule, the carrying amount is 200,000. So it's here. Alright? Are we clear? Now, we have to determine how much is the carrying amount as per taxation. Okay, carrying amount as per taxation. Now, question. So, coming back to that original cost, $300,000. How much is the recognized accumulated depreciation per tax? It's given there, $180,000. So, are we clear? Now, as per taxation's view, how much is the supposedly carrying amount? Okay, we know when you calculate carrying amount, that will be cost less accumulated depreciation less impairment loss, accumulated impairment loss. But because we don't have impairment loss here, cost less accumulated depreciation. So 300,000 less 180, right? How much? That will be $120,000. Even if we are not using this, we will be able to determine this just by using logic. Don't get confused. This is I usually encounter with the students. Some of the students are confused because they're looking it only on accounting perspective. No, when you encounter accounting for income tax, you look at it in two ways: accounting, taxation. Okay, this is I think the only tip that I can give you with regards to this. Okay, I'm not actually recommending for you to do this. This is really long. Okay, and quite confusing also at the same time. Okay, so quick thinking. Carrying amount. When you talk about carrying amount, automatically that is using accounting rule or accounting standards. Tax base, that is using tax rules. Okay? So are we clear on question number 1? Okay, where we got that 120. Now let's go and see this. Wait. Is carrying amount for that asset greater than tax base? Yes, no, yes. So which means carrying amount greater than tax base, the difference will result to taxable temporary difference. Clear? Okay, so the result, the difference between carrying amount there, carrying amount against tax base will be, the result will be taxable temporary difference. And after that, what will happen? Taxable temporary difference, if you multiply by 30%, 30% was given there, that will result to deferred tax liability. Is it correct? Alright, let's try the second one. Question number 2, it says, company recognizes a liability of $300,000 for accrued product warranty costs. As is the case for many accrued expenses, tax office does not treat the expense as deductible, okay, until the entity meets the claim. Now, accounting said we will recognize expense. So debit expense, credit accrued warranty expense. Taxation said what? The taxation office does not treat the expense as deductible. So which means this entry, as per taxation's view, should not exist. Okay? So accounting, it exists. Taxation, should not exist there. Alright? So clear how you look at it? Accounting standards against tax rule. Okay. Liability. In that case, carrying amount is $300,000. Tax base is 0. Okay, it's 0. So which means the difference between these two will result to deductible temporary difference. Okay? And then, after that, deductible temporary difference multiplied by tax rate, 30%, that will result to deferred tax asset. Okay? Accounts receivable. Now this is, as per accounting, the net realizable value, I hope you're familiar with that term, the net realizable value will be what? We have gross amount of $300,000 there, and then there is an allowance for doubtful debts. We have $60,000. So the net realizable value or the carrying amount of accounts receivable will be $300,000 less $60,000. So the amount, $240,000. So are we clear on how I got this? Okay, so clear. Now, the journal entry, I'll present you the journal entry so that it's clear for us, is debit, bad debts expense, and then credit allowance for doubtful debts. Something like this, right? Or maybe they're using different terms, but still the effect will be like this. Okay, are we clear? As per accounting record, you will journalize like this. Debit, bad debts expense, and then credit, allowance for doubtful debts. Okay, so clear? Are we clear on that? So what's the next item that mentioned here? Okay, the revenue associated with accounts receivable, $300,000 has already included in taxable income. So which means that is already sold. $300,000 is already been recognized by, the $300,000 is recognized as income of the company as per taxation rule. So are we clear? The carrying amount of the receivables is $240,000, but as per taxation rule, the journal entry is simple. It's just debit, AR, and then credit, sales. That should be $300,000. Okay, so are we clear? So which means, in the eye of the taxation office, the total revenue or allotted amount for accounts receivable is not $240,000, but how much? $300,000. Then someone will ask, Mister, what happened to that $60,000? The answer, $60,000 is what? In the eye of the taxation office, should not exist. Okay, why it should not exist? It will only be allowed as deduction if there is an actual write-off. Going back to your financial accounting, recall, there will be two ways to recognize bad debts. One is the allowance method. The second one is direct write-off. Allowance method is this. You debit expense and then credit allowance. Direct write-off is different. You debit expense and then credit accounts receivable. In this case, did we credited accounts receivable here? No. IRC and ATO in Australia only allowed bad debts to be part of the deductible portion only if it is directly written off. Is there a write-off here? No. So, the amount for AR is not 240 as per taxation's view. That should be what? 300,000. Oh, okay. Is it IRC recognized? Yes, no? Then put it here. Okay. So are we clear why we are writing 300,000 here? The reason, again, because as per IRC, there should not be deduction in accounts receivable of 60,000. IRC will say, sorry, if you haven't written it off, you are not supposed to use it as a deduction or claim it as a deduction. So AR will be $300,000. Okay? Difference. 240 against 300,000, we have 60,000. Now, is carrying amount there greater than or less than the tax base? Less than. So meaning we will use this difference between carrying amount tax base, that will result to deductible temporary difference. Okay? And then deductible temporary difference multiplied by tax rate, 30%. That will be here, 60,000 multiplied by 30%, we have $18,000. So which means that will be under deferred tax asset. Question number 4. Company has interest receivable with carrying amount of $400,000. The related revenue will be taxed when actually received. Now take note. It says the amount will be recognized only when received. Interest receivable. What is the journal entry for this interest receivable? That should be debit, interest receivable, and then credit, interest revenue. Okay? So, amount. Now, IRC said, okay, yes, you recognize it as interest receivable, but you can only claim this as a revenue when you actually receive the amount. Okay, so which means, as per IRC's view, does interest receivable exist? Yes, no. Okay, did they receive money? No. So IRC said, before you recognize this revenue, you have to receive the money. But is there any receipt of money happened there? No. So IRC says, sorry, it does not exist. Okay? So, as per accounting standards, it should exist because we are accruing interest or revenue. But, as per IRC, it doesn't exist. Alright, so, carrying amount greater than tax base, right? So, carrying amount greater than tax base, the difference between these two, what will be the result? Taxable temporary difference. And if you multiply it by tax rate 30%, that will be under deferred tax liability $120,000. Okay? Alright, question number 5. Prepaid rent of $400,000 is of course recorded here, carrying amount. The tax deduction was obtained at the time the rent was paid. So which means prepaid rent should not exist because it's already been recorded as expense. Okay, now someone will ask, Mr. How come? Okay, let's write the journal entry again. Okay, the importance is you know the journal entry when you recognize something. So when you had paid for that rent in advance, that will be debit, prepaid, rent, and then credit cash, right? Am I correct? Okay. Per IRC, if you pay for it, it's not an asset. It should be what? already an expense. So in the eye of IRC, there should not be prepaid rent because IRC says if you pay for rent, even if it is advance payment, that is allowed as deduction. So prepaid rent here should not exist. So are we clear? Should not exist. Why? Because there is no prepaid rent as per IRC's view. Per accounting, yes, because you paid rent in advance. Okay? Using accrual method and deferral method, you have to debit prepaid rent and then credit cash. That is actually correct in the eye of accounting standards. But per taxation, they will say, no need to recognize asset, this should be expense or allowable deduction. Okay? So, in the eye of IRC, prepaid rent should not exist. This is one complicated discussion. Okay? So, again, difference, carrying amount greater than tax base, $400,000 under taxable temporary difference, multiplied by 30%, you have deferred tax liability.